Welcome back to Invest Global. Today we'll be explaining sovereign credit ratings. Now, a lot of people on this channel have asked me, because I'm typically traveling around to all these different emerging markets, how can I access credit in this market? One of the most important things that I personally look at whenever I'm investing in an emerging market, currently here in Poland, I wouldn't necessarily consider this an emerging market, but it's a definitely interesting economy with an interesting stock market. Now, with sovereign credit ratings, what you want to understand is every single sovereign entity, so typically in this case, we're just talking about countries, bringing this down to kind of base level, has their own credit ratings, right? So just like you, if you're anywhere around the world, specifically let's use America for example, there's kind of three main credit bureaus that rates a person's financial history, right? So if they've had a car loan, if they've had a mortgage, if they've had credit cards, if they've had student loans, all these different things are kind of wrapped up. There's a lot of different entities that do these things. Now people use some more fintech platforms like Credit Karma. Now, when it comes to, so that's personal credit, then you have business credit. This is a little bit different. Again, using the US for an example, you can basically build off your business credit based on your personal credit, right? So if you've had zero credit throughout your whole life, maybe you're 18 years old and you just open your first credit card, right? You're going to have zero credit score to start out with. And then beyond that, you can kind of build your own credit score, and it can actually help improve your business credit score. Now, with a country, it's a lot more complex. The main indicators they look at, so just like I talked about with a person, you're looking at many things like credit history, overall length of different credit lines. You're looking at defaults on credit, similar certain aspects, right, with countries. So one of the main things is GDP growth. The other thing is per capita income. You can look at things like inflation rate. You can look at history of defaults. You can look at external debts. All these different things are kind of wrapped up with all these different credit rating companies. So the main three credit rating companies for sovereign credit is Moody's Ratings, Standard & Poor's, so S&P, people talk about this in the US, but Standard & Poor's, and then you also have, I'm drawing a blank, Fitch Ratings, okay? So these are kind of the main three that you want to look at, and personally, I like to analyze these all in one page, right? So you can go to each of these individually and kind of have this all separated out, or you can use something like FX Empire, which I do personally like, because they have all this laid out and it's pretty objective data. Personally, when I like to look at news, I like to get kind of the bird's eye view and go, okay, objectively, what is going on in the global economy? I don't necessarily want to hear, okay, what's this person's opinion or that person's opinion. I like to look at the objective facts. Then you can zoom in on whatever sector it is, kind of gain both sides perspective by kind of seeing, okay, what is CNN saying or what is Fox News saying? But I don't think those are good to go off of just taking those facts as in completely accepting them. I like to look at, okay, what's the narrative going on over here? What's the narrative going on over there? Kind of thesis, antithesis, synthesis, kind of form your own opinion, form your own synthesis, and to go from there. So the point here is when you're looking at all these different markets, you can essentially look at, okay, how are these graded? Well, if you're looking at, on a grading scale of like 1 to 10, in this case, a 10 would be a AAA rating, and a 1 would be closer to like, I think what it was the lowest it can go, like a C rating, if I remember correctly. Yeah, the lowest it can go is like a triple C. So these are interesting opportunities. Now, you want to look at this from two different ways, right? If something, for example, if a company has, the best, all the best things going for it, right? Amazing CEO, incredible numbers, incredible balance sheet. You look at you can look at P/E ratio, all these different things. You could say, okay, that's an incredible company to invest in. Versus, right? So that's kind of the one way to say it, right? So if everything's green, everything's looking great, that's an incredible opportunity. That's how some people view it. I personally am much more interested in crisis investing, right? So as an emerging market investor, as someone who's interested in blockchain and commodities and overall kind of global equities, I like to look at the situation as, okay, if everyone thinks real estate's incredible in the US and Canada and all these different markets, that's not where I look at. I like to look at markets where, hey, maybe there's a bit more distressed opportunities and you can have more upside, right? So more of a diamond in the rough opportunity versus buying something, for example, I was recently in Batumi in Georgia on the Black Sea, and everything's brand new, shiny, new appliances, all these new developments. And personally, that's not what I like to look for, right? Because if you're buying it from someone who has fixed everything up, there's nothing really you can do for a value add. I like to look at, okay, hey, what about run down homes in these areas? What about this area that people aren't looking at, right? So finding the kind of I guess you could say contrarian investment standpoint. So beyond this, sorry about that little rant, as I was saying, it's rated, you can think about it from like 1 to 10, right? So 1 is worse, that's like around the C rating. It's pretty simple on here because they lay it out with these red marks. And then best you can get is basically a AAA rating. So in this case, if you're looking at Moody's, as I said, so you have Moody's, you have Standard & Poor's, you have Fitch Ratings. The other two you can also look at are Scope Ratings and DBRS. So as far as this goes, the reason it's important to have kind of a third-party credit rating company look at these countries is because, if each of these countries were just saying, hey, these are our credit rating numbers, take it as you will. Well, that's completely biased, right? You want to have kind of an objective view on the market, at least as much as possible. So you can see here, if we're just looking at a Moody's, which is kind of one of my favorites, Australia, Argentina, CA, so not that good of a situation. And you can see how all of these differ. So you can kind of take, okay, if S&P is your favorite, great. I would still take into account what the other credit rating companies are looking at it at, because they all kind of measure these things on different factors. A lot of this is like actuarial science, right? So if one of my best friends is actually an actuary, and it's a very, very interesting job to be in right now, because a lot of it now is kind of moving a bit more towards like machine learning and things like this, right? So I think taking out as much human error as possible, especially if someone has ties to a country, it's very important to look at this from the objective view. But you can see, so if something is stable or doing incredibly well, if you're only investing in that because your risk tolerance is insanely low, it's a bit different. But if you have a higher risk tolerance, right? So if you're a bit younger, you're an investor, and you're looking at, okay, what is where can I park maybe $500,000 in a country, or spread it out in kind of a continent, where it's a bit more risky, but it has a lot more upside to grow, right? Because if something's already at a AAA rating, how much, what's the ceiling there? And that's something you have to look at, is what's the kind of like per capita ceiling, what's the GDP ceiling, like can they actually break through it, or are they just going to fluctuate? Versus if something's all the way down here, the ceiling's up here, you have a lot more long-term growth, right? So that's a very easy way to look at it. But the point here is there's many different factors to look at, like I said. So GDP growth, per capita income, inflation, external debt, many different things. But another interesting thing to look at is composite PMI, right? So this is a bit more with like trade. So with composite PMI, basically anything above 50 is looking at an expansion. And when you're looking at, if I remember correctly, it's product manager index, something like that. I apologize. I'm trying to blank on the name. Essentially, it's talking about a trade in between different countries. But anything above a 50 is basically an expansion, and anything below a 50 is a contraction, right? So that's one other thing you can look at as far as analyzing a country. This is Moody's rating site, so I will have this link down below in the description. Kind of like an old school site you can see here, but it actually has a lot of great information. This is what I like to look at personally on Moody's site here. So 6 themes that will shape a credit in 2021. They say uneven recovery, policy changes, rising debt burdens, which is a huge thing that I personally like to look at, digital transformation. So how are they doing in the banking sector? How are they doing across all these different like fintech type of plays? Environmental impacts, social trends, so all things that are important to look at. I think this is pretty interesting. Okay, so lastly, we'll also talk about S&P, but this is the main one we're going to focus in on. So Fitch Ratings, again, I like how they have it laid out, because they have the rating criteria, and you can see this here. We can move over here. So this is their actual rating criteria page. They say the master criteria is supranationals rating criteria here. Sovereign rating criteria, they have that broken down there. So we're really going to focus in on their sovereign rating criteria. Again, each of these have very differently laid out, and they typically change year to year on some of the different ways they actually lay these things out, if it'll load for us. As you can see, it's a much more complicated topic. So if you guys want me to do a longer video on this, I will. This video was just basically made to introduce you to this topic of sovereign credit ratings, just because I think some people get a little bit confused with this, and it's important to break this down. Some people may say, oh, it's much too complex to learn, but I don't like to look at it that way. I really think everyone should understand these things. It doesn't matter if you're born in Tanzania, in Mozambique. It doesn't matter if you're born in the U.S. to a rich family. I think everyone should have this equality of information. That's really what I try and focus on with this YouTube channel, because this whole idea of having guarded information where only people that study global investing or macroeconomics should understand these things, I think is completely wrong. I think everyone should at least understand these things basic, and that's what this video is basic, right? I'm just laying these things out as simply as possible that I can without really overcomplicating things. And I tried to use analogies at the beginning just so you guys could understand it a little bit better if you are used to credit ratings in your home country. So you can see here, these are the key rating drivers. So analytic pillars are structures and features of the economy, macroeconomic performance, policies and prospects, public finances, external finances. Fitch Ratings, they have all this broken down. So I don't want to bore you guys too much with this, but you can check it out for yourself. Like I said, everything that I talk about throughout this video will be linked down below in the description. This is the last website to take a look at. So with S&P Global Ratings, some of these are like a paid service. but a lot of them you can actually get a lot of free information that's very, very important. You can look at like the global credit conditions here. We can click on this and then wrap this video up. But if you guys have any questions, any comments, be sure to let me know down below in the comment section. You can also join the Telegram group, which is just a group of like-minded global investors. That is down below in the description. Also, if you use Twitter, you can follow us on Twitter at investglobal_IO. So that's also linked down below. So global credit conditions, Q3 of 2021, reopening, reflation, reset. Interesting, yeah. So you can see some of these charts here. So positive rating actions peaked in April, but remain strong. You can see this, and this is obviously in the macro economy. So this isn't, I like to look at it country by country, but you can see this for what you will. Yeah, so that's basically all for this episode. Again, I don't want to get into too many complex details. I wanted to keep this one just at a surface level basics. So as an introduction to sovereign credit ratings, I hope you guys understand a little bit better, right? So basically, just as a recap, you have similar situations with when you're rating. Essentially, the whole point of this, right? So begin with the end in mind. The whole point of this is if you're going to lend your friend $1,000, you want to look at, okay, what are the factors of that friend, right? So what have they paid you back in the past? Are they good with credit? Do they have a business? What are all these different kind of factors? That's at an insanely basic level. And then when you create kind of features on top of that, right? So derivatives, this is how you can, some people say this is how you can expand the economy. I personally, there's pros and cons to that. It's a much more convoluted conversation when you start creating all these different derivatives in the market. It basically creates for the situation where you can be insanely over leveraged. But again, topic for another day. The point here is, you go from that, then you go from, okay, individual credit ratings. So with banks in their country, typically it's with there's different ways of measuring all these different things. Equifax, Experian are kind of the main ones in the United States. And it's different based on whatever country you're in. But you look at this, basically the whole reason they give you a rating is because they want to see, okay, is this person going to pay back their debt? Like, what is the probabilities here? If you have a higher credit rating, essentially the probabilities are a bit higher that you will pay back your debt. If you have a lower credit rating, essentially the probabilities are a little bit lower that you will pay back your debt. So it goes for the same with businesses, and it essentially goes for the same with countries. Now, again, much more complicated than that. As I talked about, kind of the main things that these different kind of objective credit bureaus look at, you could say credit rating companies, as far as sovereign credit ratings are per capita income, debt to GDP, really it's GDP growth. Then you can look at external factors like external debt. You can look at overall kind of like defaults on debt in the past. You can look at inflation, and there's some other things like economic expansion, which is similar to GDP expansion. So basically all for this video. If you guys enjoyed it, like, subscribe button, all, invest global, and until next time.